Disclaimer. Over the past few years, hundreds of millions of ounces of silver quietly disappeared from global inventories. During that entire period, prices barely moved. That alone should have been a warning. Now, silver has pushed past the mid-60s per ounce, levels many analysts say haven't been seen in modern trading history. And if you think that move means the opportunity is already gone, that's exactly how this pattern usually looks at the start. According to recent reports, multiple major financial institutions are now confirming what they describe as a structural breakout. Initial targets cluster around the mid-60s and higher. Lawrence Lepard, a well-known voice in commodity investing, has publicly discussed levels near 75 by mid-2026. Others are quietly talking about 3 digits. This isn't hype, and it isn't a short-term trade. This is about recognizing a pattern that shows up again and again across economic history. A pattern where massive shortages build unnoticed, prices lag reality, and then adjust all at once. And when that adjustment begins, it rarely stops where people expect. Every time a civilization devalues its currency, every time industrial demand outruns supply, every time inventories fall to critical levels, precious metals respond. And they don't move slowly, they move violently. That's what makes this moment dangerous, because we may be watching that transition happen right now. I'm not a financial advisor. This isn't financial advice. I'm not affiliated with anyone mentioned here. This is educational analysis based on publicly available information. And if you believe central banks can simply step in and control outcomes, it's worth reconsidering what's already unfolding behind the scenes. If you believe technology will magically solve supply shortages, you're ignoring the math. And the math is unforgiving. Numbers don't care about opinions. There's a recurring structure in commodity markets that most people never notice until it's too late. 4 distinct stages: setup, expansion, crisis, explosion. Market historians have documented this pattern repeatedly in silver over the past half-century, and many believe we're approaching the final stage right now. Here's how it plays out. In early 1979, silver was trading near $6 per ounce. 2 Texas oil magnates, the Hunt brothers, noticed something most of the market ignored. Global silver production had been flat for years, while industrial demand was steadily rising. Electronics, photography, medical equipment, all required silver. So they began accumulating physical metal, futures contracts, millions of ounces. By the end of that year, silver had climbed to $15, then $20, then $30. By January of 1980, prices briefly touched $50 per ounce. In less than 12 months, silver had increased nearly tenfold. Why? Because the market finally caught up to reality. Industrial buyers panicked when they realized supply couldn't meet demand. They began hoarding. Hoarding tightened supply even further. Prices accelerated, a classic feedback loop. Eventually, regulators intervened. Rules were changed midstream. Margin requirements were raised. Forced selling followed. Prices collapsed. But here's the part most people miss. The shortage was real. The deficit was real. The price spike wasn't just speculation, it was mathematics reacting to scarcity. Fast forward to the late 1990s. The internet boom. Computers, cell phones, digital cameras. Every device required silver, paste, circuits, switches, connectors. Between roughly 1995 and 2000, analysts estimate silver demand from electronics surged by about 40%. Mine production barely moved, because most silver isn't mined directly. It's a byproduct of copper, lead, and zinc mining. When base metal production stalls, silver supply stalls with it. By the late 1990s, global inventories began falling sharply, from roughly 350 million ounces down toward 200 million in just a few years. Prices rose from around $4 to $7 by the mid-2000s, not explosive, persistent. Then came 2008, the financial crisis. Silver spiked above $20 as investors rushed toward hard assets and finally recognized that silver had been running a structural deficit for nearly a decade. And that brings us to the current chapter. In 2020, the world shut down. Supply chains fractured, and the setup phase quietly reset. Mines shut down. According to multiple industry sources, global silver production has fallen roughly 7% from its mid-2010s peak. That alone would be manageable if demand had stayed flat. It didn't. Solar panels, electric vehicles, 5G networks, AI data centers, All of them require silver and in meaningful quantities. Industry estimates now suggest solar alone consumes more than 20% of global silver supply. And solar deployment isn't slowing, it's doubling roughly every 3 years. From 2021 through 2025, the silver market has reportedly run deficits every single year, not minor gaps, structural shortfalls. Some estimates indicate that 2024 recorded a deficit near 280 million ounces, the largest on record. At the same time, governments are moving. China has announced plans to restrict silver exports beginning next year. India is importing record volumes. Commercial inventories have dropped to multi-year lows. Prices have responded. Silver has risen from roughly $18 several years ago to above $60 recently. That's more than a 250% increase in about 5 years. 3 cycles, 3 price expansions, same structure. Which brings us to now. Based on inventory data, this may be where the market shifts phases. As of late this year, reported inventories appear to be collapsing. Market observers estimate commercial warehouses hold under 300 million ounces, down from around 400 million just a couple of years ago. London vaults show a similar trend. In India, reported physical premiums have reached $7 per ounce above spot. Buyers are paying extra simply to secure delivery. That's not speculation, that's shortage. Export restrictions from China are expected to remove a major supplier from the global market, forcing domestic retention of refined metal. At the same time, investment demand is accelerating. In early December alone, silver ETFs reportedly added hundreds of tons. Major funds now hold their largest positions since the early 2020s. Macro conditions are adding fuel. The Federal Reserve has begun easing. Real yields are falling. The dollar is weakening. Historically, that combination has been supportive for silver. But the clearest signal is here. Silver lease rates have surged. It's becoming expensive to borrow physical metal. Why? Because there isn't enough of it. Industrial users are racing to lock in supply. Investors are moving from paper to physical. The market is starting to accept that this isn't temporary, it's structural. And once that realization spreads, prices don't adjust slowly. You've heard this argument before. Commodities spike, then they crash. Silver hit $50 in 1980 and collapsed. It hit nearly $50 again in 2011 and collapsed. So why would this time be any different? Look at what drove demand back then. In 1980, silver demand was largely speculative. Photography was a major end user. When regulators changed the rules and the Hunt brothers were forced out, demand vanished. And over time, photography itself became obsolete. That demand didn't just slow, it disappeared. Today's demand is different. It isn't speculative, it's industrial. Solar panels require silver, and there is no economically viable substitute at scale. Electric vehicles require silver. AI data centers require silver. Fifth-generation networks require silver. Medical devices require silver. These industries aren't shrinking, they're expanding. And supply can't respond easily. Why? Because silver is primarily a byproduct metal. Roughly 70% of global supply comes from copper, lead, and zinc mining. Unless those base metals see massive price increases, silver production doesn't rise with silver prices. Even when primary silver mines are developed, industry experts estimate it takes 7 to 10 years from discovery to meaningful output. By then, current deficits could consume another billion ounces or more. Now look at the supporting factors. First, supply. China has moved to restrict silver exports, not because it doesn't value trade, but because it needs the metal internally for solar deployment, electrification, and industrial expansion. That removes a significant portion of refined supply from the global market with no clear replacement. Second, monetary conditions. The Federal Reserve has shifted toward easing. Liquidity is increasing. Real yields are falling. Historically, when currencies weaken, hard assets respond. Gold, silver, commodities. Silver, unlike gold, has industrial utility. That means it benefits from both monetary debasement and physical scarcity. A double tailwind. Third, awareness. Most investors still don't own silver. Market data shows widespread ownership of stocks and growing exposure to gold, but silver remains largely ignored. That matters. When mainstream awareness arrives, when major financial media begins covering it consistently, when retail investors start asking questions, demand can accelerate quickly, and there may not be enough physical metal to meet it. The usual counterargument is substitution. Technology will replace silver. People said the same thing about copper, about lithium, about rare earths. At scale, it rarely happened. Silver has unique properties: the highest electrical conductivity of any metal, the highest thermal conductivity, antibacterial characteristics, high reflectivity. You can't simply swap it out in most critical applications. Yes, engineers are working to reduce silver usage, thinner pastes, efficiency gains, alternative designs, but even optimistic projections suggest this may slow demand growth, not reverse it. And solar is only part of the equation. Electric vehicles, 5G infrastructure, AI systems, medical technology, all continue to grow. Even if solar demand dropped by 10%, other sectors could absorb the difference. What about recycling? Recycling contributes roughly 200 million ounces per year, but it isn't scaling fast enough. Most silver is used in tiny, dispersed amounts, difficult and expensive to recover, which leaves the same conclusion. Demand is structural, supply is constrained, and the gap isn't closing. Circuit boards, solar panels, medical equipment. Most silver is embedded in products where recovery is expensive and delayed until end of life. Solar panels last roughly 25 years. Panels installed in the early 2000s are only now beginning to enter the recycling stream. By the time recycling meaningfully scales, current deficits could consume billions of additional ounces. So what about manipulation? What about paper markets? Paper contracts don't solve a physical shortage. If you're running a solar factory, a futures contract doesn't power production. You need metal. And when physical buyers start competing directly for limited supply, the paper market loses relevance. We've seen this before. In nickel, in 2022, price controls failed, trading froze, the market broke. Prices went vertical once physical demand overwhelmed paper mechanisms. Silver operates under the same rules. So where could this realistically go? Here's what analysts are discussing. As we move into early 2026, price ranges in the mid-60s to low 70s are increasingly cited by major financial institutions. That's not based on speculation. It's based on inventory math. If export restrictions tighten and physical shortages persist, ETF inflows could continue. Industrial buyers may begin locking in supply at any available price. Once silver sustains a move beyond the high 60s, some technical analysts note limited resistance until the mid-70s. That sets up a potential next range, $70 to $80 as inventories continue to draw down. This aligns with projections discussed by Lawrence Leopard and others, placing silver near 75 by mid-2026. The reasoning is straightforward. Another year of deficits in the range of 150 million ounces could push global inventories toward levels many consider dangerous. Below 200 million ounces. That's less than 2 months of supply. Historically, when inventories fall that low, markets don't adjust smoothly. They gap. 10% moves in a day, 20% moves in a week. If mainstream media attention accelerates and retail participation increases, momentum can become self-reinforcing. That opens the discussion many are hesitant to have publicly: $80, $100, potentially higher. Not as a forecast, but as a consequence. Looking slightly further out, if solar deployment continues at current rates, some estimates suggest total silver demand could approach 800 million ounces within the next few years. Supply might reach 850 million, assuming recycling improves. That's a razor-thin margin. Any disruption, any mine closure, any unexpected surge in industrial demand, and the system enters crisis mode. At that point, prices don't rise because people are excited. They rise because there's nothing left to buy. Some analysts at large institutions have begun discussing 3-digit price scenarios by the end of next year. Technical momentum models suggest even higher levels could be possible if the breakout accelerates. $100 isn't a fantasy number. From current levels, it represents a move of roughly 50 to 60%. We've seen that before. Gold rose from around 1,800 to roughly 2,700 in just 2 years. That was a 50% move. And gold did that without running persistent physical deficits. Silver doesn't have that luxury. So what do people typically do with information like this? There are a few common approaches. The first is physical metal, coins and bars held outside the traditional banking system. You own the asset directly. No counterparty, no paper promises. There are trade-offs, premiums over spot price. Storage considerations. Liquidity is an instant. But if the structural thesis holds, physical silver functions less like a trade and more like insurance. The second route is exchange-traded products backed by physical metal. They offer liquidity. You can buy and sell quickly. No storage logistics. But they introduce counterparty risk. If financial stress intensifies, ETF structures rely on systems continuing to function as designed. That risk doesn't show up in normal times. The third option people discuss is mining companies. This is the leveraged exposure. When silver rises, miners can move faster. A 10% move in silver can translate into much larger moves in mining equities. But leverage cuts both ways. Miners carry operational risk. Labor disputes, cost inflation, geopolitical exposure, management execution. They are volatile even in strong commodity cycles. And then there's the fourth option. Do nothing. Assume this time is different. Assume supply appears. Assume technology solves the problem quickly. Assume the pattern breaks. That's a position too. But if it's wrong, the move happens without you. Markets don't move in straight lines. Silver will have pullbacks, corrections, days where it drops 5 or 10% and sentiment flips overnight. When that happens, many people panic. They declare the move over. They say the breakout failed. History suggests otherwise. If the deficit is real, if inventories stay tight, if industrial demand remains locked in, short-term volatility doesn't change the math. Hundreds of millions of ounces already gone. Another substantial deficit likely ahead. Limited new supply for years. That's why many analysts describe this setup as unusually asymmetric. The downside, in their view, is a retreat toward the mid-50s. The upside depends on how severe the shortage becomes once the market fully acknowledges it. And by the time that acknowledgement is widespread, the easy part of the move is usually over. On the upside, some forecasts point toward $100 or more. That creates a risk-reward profile many describe as unusually asymmetric. 5 to 1. In some models, even higher. For thousands of years, silver has played the same role. Money. A store of value, a hedge against currency debasement. And throughout history, the response has been consistent. Every time a civilization aggressively expanded its money supply, every time industrial demand surged faster than supply, every time inventories fell below critical levels, silver didn't drift higher. It moved sharply. Ancient Rome, the Byzantine Empire, Weimar Germany, the Hunt Brothers era, the dot-com cycle, different centuries, different systems, same structure. The reason is simple. Human behavior doesn't change. Governments print when under pressure. Industries consume resources. Scarcity forces repricing. That's why projections around $75 by mid-2026 aren't random guesses. To those who study these cycles, they represent the next chapter of a story that has played out repeatedly across economic history. Major institutions are watching it. Commodity analysts are tracking it. Technical charts reflect it. Inventory math supports it. The question isn't whether the pattern exists, it's whether you're paying attention as it unfolds. Because if this breakout is real, it isn't something that happens all at once in hindsight. It happens quietly at first, while most people are still debating whether it's real, while you're reading this, while you're processing it. This analysis is educational and informational only. It reflects publicly available data, analyst commentary, and historical precedent. It is not financial advice. The pattern doesn't need belief. It only requires time.